So as U.S. trade policy continues to be negotiated, and with a major tax bill now signed into law, our survey shows the United States as the top market for investment opportunity in the near term, chosen by our respondents 53% of the time. So just let that sink in.
Hello and welcome to the REIT Report. I'm your host, Sarah Borkson-Keto. Today's special episode is sponsored by Deloitte, a NAREIT Platinum Industry Partner. My guest from Deloitte is Sally-Ann Flood, Vice Chair and U.S. Real Estate Sector Leader. Sally-Ann is joining me to discuss some of the highlights of Deloitte's 2026 Commercial Real Estate Outlook. Sally-Ann, a pleasure to have you back on the podcast.
Great to be back again, Sarah. Thank you for having me.
So, Sally, at the outset, can you talk a little bit about the methodology Deloitte used to produce the 2026 outlook and how you would describe the overall mood among real estate owners and investors that it presents?
Happy to. So we conducted a survey of more than 850 C-level executives and their direct reports at commercial real estate owners and investment companies with assets under management of at least 250 million. And the survey was conducted back in June and July of 25. Our respondents were broadly based out of three regions: North America, Europe, and Asia Pacific. And overall, for business and industry expectations, this year's Outlook Sentiment Index scored at 65. And what does that mean? It's well above the 23 trough of 44. And this was just below last year's high of 68. So at the end of the day, we're seeing that optimism is persisting. And the index itself measures what degree of optimism or pessimism our survey respondents identified for revenue, expense, and CRE fundamental expectations at their organizations for over the next 12 to 18 months.
So, Sally, what would you say some of the key factors are that underpin that broader sentiment? And to what extent do they overlap with what you've seen in previous years?
When we asked how our survey respondents expect their revenues and expenses to change for the coming 12 to 18 months, there was a slight pullback in optimism from last year's survey. I think 83% expect their revenues to improve by the end of the year compared to 88% last year. And across all we surveyed, the spending areas, which included operations, office space, and technology, fewer respondents planned to increase spending compared to prior year. However, overall, 68% still anticipate higher expenses this coming year. And we noticed a similar pattern around expectations for the CRE fundamentals. And many respondents still expect all conditions surveyed, like rental rates, leasing activity, vacancies, and cost of capital, all to improve through 26 compared to last year. So despite macroeconomic uncertainties, these fundamentals don't change overnight, and growth is still expected across most asset classes and most geographies.
Great. And is it possible to highlight where you saw the most positive sentiment in terms of global property sectors?
Yes, we continue to see the most positive sentiment focused on a similar sample of 5 global sectors year over year. The top 5 global sectors this year were digital economy, which includes data centers and cell towers, logistics and warehousing, industrial and manufacturing, multifamily, and then closing out with office suburban. The U.S. respondents had one change in the top 5, with life sciences and biotech replacing the office suburban sector. And so we noticed that the structural demand patterns for one of the top 5 sectors, industrial, should support measured long-term growth. And users seeking specific needs have already established a robust build-to-suit development pipeline. Each of these top 5 have opportunities if you know where to look. And then data centers are obviously still very interesting to us. It was, again, a top response for nearly 4 years in a row. As with many sectors right now in the real estate cycle, demand is well exceeding new construction, and there's no signs of slowing down. There is fierce competition for space, and in many markets, space is often pre-committed and leased before new centers can even be completed.
And Sally-Ann, any areas of weakness or more challenging sectors that you saw?
The pandemic era maligned office sector, it is showing signs of life. So amongst our global survey respondents, both the suburban and downtown office types did move up in our property sector rankings for the second consecutive year. Growing owner and investor interest in office properties is likely supported by a combination of global factors: progress in office reentry programs, record low new construction, leading to heavy competition for well-located, high-quality office space.
And let's turn to sentiment around the capital markets for CRE. What are you seeing in terms of expectations for cost and access to capital? And how is that shaping activity in the sector?
Well, respondents identified capital availability, elevated interest rates, and cost of capital as the macroeconomic trends that could most negatively impact their financial performance for the next 12 to 18 months. And that's not really a surprise. Like the European respondents expressed the most optimism across all fundamental conditions, which included capital markets. And they had 70% of respondents from the region expecting improvements. However, the North American respondents were on average much more neutral compared to other regions, with only 25% expecting conditions like rent growth, vacancies, and cost of capital to remain flat year over year. And then Asia Pacific respondents, they had a larger share expecting lending related metrics like cost of capital and capital availability to worsen. But looking ahead, I think the main driver shaping activity is going to be the lending market. Like CRE lending seems to be the tale of two markets. One, pressure on legacy loans, and two, new lending opportunities. So when you look at existing loans, they're often stressed by the refinancing difficulties and defaults. Only 21% of the global respondents expect to pay off their loans in full at maturity. 34% plan to extend or modify their loans, with another 15% that expect their loans will reach foreclosure or begin the process to hand properties back. And so amid this turmoil, a brighter story may be emerging for new CRE debt origination with new lending opportunities. Investors and lenders who have fresh capital, unburdened by yesterday's troubled loans, they have an opportunity to access debt markets for strategic capital deployment into CRE. And through the beginning of 25, new loan volume increased 13% from the end of 24 and over 90% from the same time last year. So access to debt capital has improved, and it could become even more robust going forward. Property value resets have definitely helped unlock liquidity, prompting some lenders and borrowers to re-engage. So all property sectors have seen an increase in the active lenders. We're seeing as well the alternative debt sources appear to have been the driving force behind this resurgence. So lenders such as private credit funds or high net worth individuals often add to the global pool of available debt capital as they target diversification through high yielding real estate assets. And these sources I find interesting. They accounted for 24% of the US CRE lending volume last year, which exceeded the 10-year average of 14%. So lenders like banks and the commercial mortgage-backed security lenders, they're cautiously re-entering an evolved CRE debt market following years of inactivity. CMBS lending, they recorded a 110% year-over-year jump, driven by single borrower deals through early 25.
So it definitely sounds like CRE organizations are looking for ways to expand their capital access today.
They are. And it's interesting to see, like, how are they doing it and what methods can they pursue? And we're seeing that strategic partnerships and alliances continue to expand access to CRE capital. And I think that's really going to diversify the investment channels. This is part of the new playbook for fund managers, insurance firms, retirement accounts, wealth management organizations, and private real estate is serving as the key beneficiary, which is great. Like interest in real estate among those high net worth individuals, it's holding at 19%, a level we have not seen since before the global financial crisis, when allocations peaked at 24% back in 2006. And public REITs, they're also ramping up their pursuit of partnerships with private capital providers, a notable shift in how these firms approach growth and diversification. The REITs are continuing to turn to joint ventures, co-investment vehicles with pension funds, sovereign wealth funds, and other institutional organizations. And these alliances, we're seeing they're just more than a funding source. Like they're a strategic lever for scaling up, diversifying income, and navigating a real estate market truly in flux. Like these institutional investors should seek to actively engage with states and municipalities because I think they can help showcase the public-private partnership models for specialized uses, including media, entertainment, healthcare, energy-related infrastructure initiatives, and affordable or student housing. And that can help bridge the funding gap that we're really seeing and experiencing locally.
And Sally-Ann, any discussion about CRE today must include AI. Is the industry still on a learning curve with regard to AI integration? And is there any consensus on the best and highest use of AI at this time?
I completely agree, Sarah. We can't have a conversation without talking about AI. And the CRE organizations are moving along the adoption curve. And there was definitely some signs of early stage growing pains. We saw a 20% annual increase in the number of respondents that are either facing challenges with their AI integration or just seeing a limited impact. Now, this could be due to a multitude of reasons, like technical issues, lack of expertise, or cultural resistance to the change. So I feel commercial real estate, we've moved past the buzz, right? Shifting its attention from hype to the practical applications of AI that promise clear, measurable returns. So while excitement and intrigue about AI's potential remains high, industry players are now taking a much more calibrated approach, methodically identifying and zeroing in on cases that deliver real value. And on those highest and best use cases at this time, we kind of need to look beyond the chatbots, like smaller, more efficient AI models with increased sector-specific specializations. They seem to be gaining traction across the industry. Most voice and chat assistants, they're no longer novelties. Like they're often becoming just common tools for engaging prospects and qualifying leads. So survey respondents appeared enthusiastic about different emerging AI technologies. And executives are really increasingly demanding a clear return on these investments. So we're seeing organizations shifting away from the broad scattershot strategies in favor of targeted deployments in areas of the greatest potential for impact. So think about it, it's tenant relationship management, new lease drafting, portfolio management. These have all emerged as clear front runners, with firms seeing incremental improvements. Mixed and transformative impact, mentioning these functions as the area of focus in the next 12 to 18 months. So as these organizations kind of advance, I think the imperative is to embed these technologies into their interconnected business processes. The next frontier is the evolution towards cognitive systems, systems with advanced reasoning, decision-making capabilities that can simulate human behavior. So for businesses, the goal will shift from incremental improvement to a fundamental reinvention of the business process as technology advances. But the preparation really has to start now with modernized data and with processes. And the critical considerations about exploring what we just mentioned, it's getting the data component right. That's critical. And if we can see and bring the entire technology platform and have a more collaborative approach with your finance and SOX function, I think streamlining and enhancing key activities such as risk assessment, control design, ongoing monitoring, remediation, reporting, testing, all these automation capabilities of Gen AI, they not only speed up processes, but they improve accuracy and effectiveness. And they enable organizations to manage compliance much more proactively and efficiently. So I think by integrating risk management and internal audit oversight from the outset, I feel companies can effectively identify and address potential compliance gaps, like safeguard the data integrity optimize their control environment, making modernization efforts both secure and, at the end of the day, sustainable.
Great. Now, Sally Ann, we've covered lots of ground today, but are there any additional topics or themes from the outlook that you feel really speak to the mood of the industry at this time?
You can't really ignore the trade-related uncertainties because they have dominated the global narrative. And while regulatory and tax policies have injected further uncertainty into businesses' decision-making. So when we asked about what macroeconomic trends could most negatively impact their financial performance, respondents did also identify changes in tax policy for the second consecutive year. In last year's outlook, we attributed this abnormally high result to the combination of global tax regimes coming into effect and election years crossing many jurisdictions. We estimate this remained elevated again due to recent U.S. tax proposals. An example here could include Section 899, that while ultimately not enacted when the One Big Beautiful Bill was signed into law on July 4th, but during the time of this survey fielding, it would have increased rates on foreign investment into the U.S. So we're seeing that leaders still see commercial real estate as potentially a safe investment haven, given its performance during similar periods of uncertainty in the past. And we saw 75% of global respondents will plan to increase their investment levels in real estate over the next 12 to 18 months, which is positive. And doing so, most for benefits as an investment, acting as a potential hedge against inflation at 34%, or greater diversification with other financial asset types, stability as an asset class, and for potential tax benefits at 14%. So as U.S. trade policy continues to be negotiated, and with a major tax bill now signed into law, our survey shows the United States as the top market for investment opportunity in the near term, chosen by our respondents 53% of the time. So just let that sink in. So I think CRE leaders should keep a pragmatic playbook in 26, have capital agility, rebalance towards resilient income, partner for scale and operating expertise, deploy AI where it demonstrably advances leasing, underwriting, portfolio decisions, and not just for show. So I think stress test these legacy exposures and sharpen transparency. I think you can move before the crowd. Like the early mover window, it's still open, but it's potentially closing. So don't wait for that certainty. The opportunities are there. I think you just need to go find it.
Sally, thanks so much for your time today.
You're welcome. Thank you, Sarah.
And to our listeners, be sure to explore the more than 500 previous episodes of the REIT Report on your favorite podcast platform.